Hey, before we jump into today's show, we record Golden Rule Radio on Wednesday afternoons for a Thursday release. Today actually is Thursday, March 12th as I speak, and it could not be more volatile or portfolio unsettling out there right now. With all the coronavirus measures, equity market drops, and precious metals price pullbacks, you're likely wondering what to do, where to go with your investments, and as a result, we really wanted to give you clear, concise direction today on what to do. And I'm going to give you 3 P's and 3 R's. First of all, this is a time for peace, not fear. Prudence, well thought out approach, right? Not a panic. And for protection. So take lessons from 2007 to 2009. That being said, now we're going to tell you plainly what to do through these 3 R's. One is retirement. Protect a portion of your IRA or your 401k by moving into tangible, physical metals that offset the paper markets and do not ever become worth zero. We can do that for you. 2, restructure. If you have an existing precious metals portfolio, strongly consider restructuring it. Take advantage of the extreme ratios for the sake of compounding ounces over time. It will work eventually, even if the precious metals prices come down, but taking some gold and moving to silver and platinum right now is a huge opportunity, specifically bags of 90% US junk silver coins. We can also assist you with this strategy. 3, rebalance your portfolio. Take the time to review your current percentages per the investment triangle on the screen. Screenshot this or pause the program, whatever it takes. When prices swing this much, you have to take the time to learn where you sit. Don't just flee into cash positions blindly. With this approach, you'll know how to move monies accordingly into different categories for both profit and protection. Call us and we'll take 3 minutes to run through it together. We just really want to thank you guys for listening to the program. Enjoy today's Golden Rule Radio, and more than anything, again, this is a time for peace. Hang in there and don't hesitate to call with any questions. Now let's jump into yesterday's recorded program. Welcome back to Golden Rule Radio. What an amazing month this has already been, much less an amazing week. You guys, this honestly reminds me of 2008. Call it subjective. We can even objectively measure in some regards the sense of comparison to the beginning of 2008's drop. You know, we had a big Bear Stearns and then Lehman Brothers event, and we're seeing some similar things play out now, both virus-wise and market-wise. But real brief recap, ton of volatility in the precious metals markets, high of 1683 since last week's show, but we're at 1636 as we record. That's only a 2.8% pullback. Silver, a lot of volatility as well, 5% in the week with a high of about 1745 and a low of 1660. Platinum is retraced, similar to gold today, about 0.65% or 65 basis points, but it's been steady Eddie really for the most part this week when compared to the other ones, because looking at palladium down 5.5% today alone, 11% volatility on the week, and man, that's retraced from 2440 all the way to 2185 since last week's show. So that being said, Robert, I'm going to kick this off to you and take it and run.
Well, you talk about 2008, and there are a lot of similarities that are going on in the markets, especially with the stock market falling like it is. But what I want to highlight here is with the dollar index and what it's done over the last couple of months. I think there's a lot of significant points to make at the dollar index action related to the stock market. And what else related to, gold. So I want to start at the first of the year, literally January 1. The dollar index formed a doji candle. It was not exactly a perfect doji, but moving on from that, doji candle can be neutral type of pattern, but they can indicate some important turns in the market. And this time, that doji candle and the dollar index indicated on January 1 that there was a turn, and dollar index was at 96.5. Dollar index then rose for the next 7 weeks, tried to break above 100 and failed, but it did better the previous high from October 1. And so it came just above it, broke just above that previous high, but failed 100 and stopped shy of 199.91. And that was the peak. Anybody want to guess what date that was? February 20th. That's what it was. Then it turned down and moved down for 12 days. That's where we are this week.
Big move down.
Big move down. So then it broke below that previous low that it was at January 1. And I'll let Miles put some charts up here and show this move in the dollar index, but it touched the Fibonacci level of 1.414, which was below that previous low set on January 1. That was about a 5% decline in the dollar from February 20th, remember that date, February 20th down to March 9th. Now let's look at what happened in stocks. Stocks rose from January 1 through what date? February 20th. February 20th, it peaked on the same day the dollar peaked. It then declined from February 20th, the stock market and the dollar. Stock market lost about 25% if you're measuring it with the S&P 500, top on February 20th. Is that a coincidence? I don't think so. Tori mentioned at the beginning of the show about 2008 and the similarities of 2008. Yes, the stock market is falling down like 2008. The dollar is declining in tandem with the stock market. Comparing what the dollar did with the stock market in relation to the stock market in 2008, from May 2008 to March 2009, the stock market fell roughly, let's say 50%. The dollar rose from 72 on the index up to 89. So as the market was coming down, the dollar was the safe haven. This time it's not. The stock market's going down, the dollar's going down. That's significant. What else is happening? The bond market is going up. It's a safe haven. And what else? Gold. Gold has risen about 5% in that same time period. I think we have a neat dynamic where this time it actually is different because the stock market is declining. The dollar is not being treated as a safe haven. It is actually being sold off to the day with the stock market. So the world is not viewing the dollar as the safe haven as it did in 2008. I think that's a major difference. And a major difference is that gold's rising, whereas then gold was volatile in 2008 and actually was about flat with the stock market decline. It did finish 2008 at a higher number, and it's been bullish since. But that point, I think, is going to continue because the world is not seeing the dollar as the safe haven it was in 2008.
So that ties in closely, too, to what we saw gold do in 2008 on that initial crash. Gold did retrace, and I've been asked by some clients, are we going to see that again? And I'm going to put up two more charts here so that you can see what gold has done versus the Dow, just the Dow here in the last 15 months and 24 months, right? So gold is up over 35%, and the Dow is down almost 10% in that same period of time. Right? Not from peak to trough or trough to peak. I'm talking about in comparison to like a zero baseline. If you go back 2 years, it's still telling you. So we've talked about gold telling a story here about what is about to come. It's been saying something is happening, something's been wrong in the markets. Eric's been crying about the repo market. He's going to get into that a little bit too, and just the severe amount of Fed intervention, which I don't think we've seen anything yet. But what we are not seeing is gold come down sharply like the equities markets are, as gold did in 2008. And that argues your point. It's not the dollar this time, right? That dollar strength certainly attributed to a decline in the gold price. Now we're seeing more of a Swiss franc climb.
But Tori, that's all because gold is a currency hedge, right? Gold is not a hedge against the stock market. It is on a fundamental basis, but technically the reason why gold does well in a stock market crash is because of the intervention that follows that stock market crash, which is quantitative easing, rate cuts. We saw Bank of England last night cut rates again. The Fed today announced that they're upping their repo intervention to $175 billion per night from here until April 13th. So I did the math on that. If they do it only on weekdays that the market's open, from now until April 13th, that would be $4.025 billion that they've printed.
Wow.
What does that do to the gold price right there?
Yeah, and it won't reflect on their balance sheet like that, right? It's a short-term overnight emergency type lending to keep credit markets active and what have you, and keeping banks able to lend and everything from really freezing up. It maintains the velocity of money. But, the other issue is we haven't even seen anything yet with that repo market. Now, remember, we started and we were screaming about it when it was $60 billion.
Back in the fall,
yeah. Right? And then they go to 100 and we're like, what? Well, just this week they went to 150. And now here's Eric coming in my cubicle saying they just upped it to 175. It lasted a matter of days. So 175 till April probably isn't what we're going to see it stop at. And in my opinion, too, that's nothing compared to what we're getting ready to see from a true stimulus package with some form of capital, or liquidity injection into the markets.
Yeah, liquidity being the key word there. That's what's going on.
But really what we're talking about here is going back to an environment where it's not about return on capital, it's about a return of capital, right? And Robert, you mentioned that Bill King had said, look, it's time to look into what is backing your money market account. Remember, all the money market rules have changed too since 2008, 9, and 10. They rewrote the laws, and they can freeze that money up so that there isn't a run out of money market accounts, because that's trillions of dollars that will really destabilize the economy.
Well, Tori, we've had a lot of clients call in this week, a little bit worried that they've kind of missed the boat on this gold move up with the market crashing, but the ratios show a different story. What would you say to that investor on the fence that's looking at their 401k right now or their IRA that's just getting pummeled? Have they missed a little bit of a gold run, or is it still looking like a good time for them to hop in?
I appreciate the question, and I had a client ask me the same thing and saying, look, if we do see that retracement, what happens to the ratio? Because the gold-silver ratio topped out Sunday night at 99-1 because gold hit $1,700 intraday in the Asian market while we were all sleeping almost. Mm-hmm. And so those are highs, the highest that we've seen, like we talked about last week, and above 95-1, we've spent less than a week in history there in terms of a gold-silver ratio. So whether we see a retracement or not, look, you buy on the ratio. You buy silver here to compound your ounces, right? It's about accumulating gold over time, over the course of a couple of decades in a portfolio, but certainly don't ignore the silver piece. If you start on that side of the fence now, it's like getting gold at 50 cents on the dollar. And so whether there's a retracement or not, you're almost immune to it because we'll move you into gold later. That's certainly one thing. The other is on these dips, like what we're seeing today, these little pullbacks, to Robert's point, as long as we're seeing the currency do what it's doing and instability in the markets, here's going to be the big impetus. The big impetus is going to be the Trump administration response. So when we know it's coming, we just hit a technical bear market in the equities markets today officially. The transports were already there. But now you're seeing this pullback into bear market territory. They're going to fight it hard, just like they did in December 2018, where we saw an immediate reversal to only come back and set new highs. I expect there to be a little bit of a rally with major stimulus, but this time it's currency debasement. Like the overnight repo deal is not currency debasement, right? And so I think that's part of what you've seen, Robert, with the currency as well, and we haven't even seen it yet. That really, in all likelihood, we should see the dollar go back down into the 80s or the 70s as they throw a ton of money at this.
Yeah, I'll also add to your timing on gold is we're in the month of March. March can be seasonally weaker for gold. So I wouldn't be surprised to see gold soften as it actually is kind of starting today. And maybe by the time the show posts Thursday, we will see lower numbers. But March can be a weaker month for gold. I think that is, not to use the term too much, an opportunity. That's probably your next opportunity to be buying at lower prices. If you've been sitting out, watching gold rise and trying to wonder, is it going to pull back or what have you? I think in the next few weeks, you're going to get probably an opportunity to do so. I don't know how low. We'll see where it wants to go in the next few days and try to make a little bit more of an accurate prediction on next week's show. But I think gold could soften here and give you an opportunity, but then it is acting as that safe haven. So it's the ripe environment for it to not pull back. It's just potentially a trading pullback move that gives you a little bit of better entry price.
Keep in mind too, that I believe next Wednesday, a week from now, we got the Fed that's probably going to cut rates again, which has given gold some strength the last few times they've cut. The emergency cut, which happened last week or the week before, gave gold an immediate, $50, $60 pump. So be aware of that as well. Another ratio that we mentioned a little bit less, but we really have to take a look at right now, especially with the thousands of articles you're going to see in the next couple of days that the equities market is in a true bear market now, is the gold Dow ratio. Tori, why don't you speak on the gold Dow ratio and what it's done this week?
Yeah, we've tracked that for years. David speaks often about it on the McIlvaney Weekly Commentary. It really helps guide and direct rebalancing of portfolios. And I'll talk about not only that, but just sort of why you be adding to your precious metals position in this type of an environment, because over the long term, that balance is huge. The Dow gold ratio, actually, if you just take the Dow and you divide by gold, we were at 19 to 1. Now we're all the way down at 14.5 to 1, which is a 24% tightening, right? So that means your portfolio is 24% better than having just been in stocks alone. That's that asset preservation piece. Don't just look at gold as a performance base. I'll tell you a mistake that a lot of our clients made that came in late to the game in 2010 and 11 is they were chasing price performance. That's not what it's about. It's about being those people that got in 2006, 7, and 8, really before the major run. And that's where we are right now. This is 2008. This isn't 2010. Okay, so that is what I'd say on that. On watch that, and when it gets down to around 4 to 1, then you start looking at moving into equities where they're the most undervalued. But taking a look too at what gold does over the long term, here's a chart just on the 50-year performance of $1,000 invested just in stocks versus a 75%, 25% stock and bond portfolio.
Say that again. You've got a just stock portfolio, right?
Right.
And then you've got a portfolio with
75% stocks and 25% bonds.
Okay.
And then you have a portfolio with 75% stocks and 25% gold.
Okay.
All right. So by annually rebalancing this, you'll see that you actually have about a 34% better performance over the course of 50 years by having gold in the portfolio versus bonds. So you're talking about what bonds are doing right now and people seeing them as a flight to safety. There's nowhere for bonds to go. Look at what the bonds have done over the last 10 years. Right, so there's far more risk going into them than there is reward. But look too at the performance in 2008. The last time we saw the equities come down, and they came down 36% on average. Bonds dropped about 6.8%. Gold went up 3.4%. So again, you see the effect on a total portfolio here of having a gold position in your portfolio, and whatever percentage that is, the higher the percentage, the more the stability.
Well, Tori, in the 50-year performance, if you look at the 75 stocks, 25% gold, how many ratio trades have we hit in the last 50 years? I mean, this is the most undervalued chart that there is.
Metals ratios, right?
Exactly. I'm talking compounding ounces from gold to silver, silver to gold, platinum to I mean, it's absurd. So this is the low end of the spectrum. If you get someone to truly manage your precious metals portfolio, we could make this chart look a lot different.
That's a really good point.
Yeah, back in the 70s, I know George, who was trading metals back in the 70s, has the numbers too, where when you saw gold top out at 800, coming all the way up from roughly $50 an ounce, with the ratio trades built into that, an original $10,000 investment in gold ended up being worth over $1 million when the market topped. And that is because of the compounding effect of multiple ounces. Just like taking dividends of a stock, reinvesting it in the purchase of new shares. When the share price is down, you accumulate shares. So when the share price rises, you have that compounding effect, nominally or monetarily to your portfolio.
And keep in mind, this is something that we do inside of IRAs. So all tax deferred swaps, no negative implications on that side as well. And so as you're looking, this week at your 401k or your IRA, feel free, give one of our advisors a call here. We'd love to run you through it. Well, Tori, why don't you give everybody as best as you can, a hypothesis of what the week's going to play out to be. We had the World Health Organization earlier today declare coronavirus as a pandemic. I saw Trump on TV earlier. He looks angry. He does not look like a happy camper. But between the Fed meeting next week, Trump giving a speech tonight, I believe, and everything else taking place. Don't forget about the Democratic primaries and the fact that we have an election this year. But what
getting lost in the shuffle.
What can you tell the listeners to look out for this week?
Boy, anything goes. I mean, Robert's sitting here looking at me, shaking his head. Who knows how to answer that question? But certainly a rate cut, whether it's next Wednesday or before.
Possibly,
yeah. I mean, it could be another emergency one, depending on what the markets do tomorrow. President Trump is going to have a press conference tonight, and we know that he will stop at nothing to try to keep the markets propped and keep the economy thriving. And certainly the coronavirus fears don't help. We have seen some manufacturing pick back up in Wuhan, China. And so maybe that's a good sign. But as we know, the rest of the world, and especially the United States, is weeks behind in terms of the way that goes. And we're seeing a lot of closures from events to school districts to college campuses already. So we have a piece on supply chain disruption. I would definitely call us and try to get a copy of that, because that kind of goes into what to expect on an economic slowdown. And I do believe that we will see unprecedented stimulus. You need to be ready. And I heard David even say this, you need to be ready for a $1 trillion budget deficit to turn into a $2 trillion budget deficit this year. That's the type of enormity that I think, and they're talking about a payroll tax holiday that would certainly have an immediate impact on businesses and employees, about 7% per side. And so I think all of the above is going to be something that we see play out in the next week. It's going to weaken the dollar. It will be currency debasement this time, and it's going to spike gold.
Yeah, I'd say that they're just trying to manage perception right now with the coronavirus as well as the stock market. I think it's tied together there. Trying to manage the public's perception, both with the market and the virus. I think through managing that perception, I think there's inevitability that fear does become the predominant theme in the market. And I was talking to a guy before I came in here to record, and he said a few months ago he woke up in a sweat, realizing that his mom's retirement, he was managing, he has power of attorney. He said he woke up in a sweat, realizing that all his mom's assets are in paper assets. And he realized he didn't have a single ounce of gold, realized that wasn't responsible, started buying gold, and now he's happy. Here we are going into that fear-based driven economy, I think, given the market's turning officially bearish today or soon. And that fear we saw in 2008 take hold, and there were waiting lists to be able to buy gold. So gold went off the shelves. Supply.
Silver too.
Yep, that's right. High premiums. And so ahead of that fear coming, I would encourage you to be positioned so that you don't have to pay higher prices and higher premiums.
Well, that's going to do it for this week's show. Make sure you wash your hands. If you like what you heard, go ahead and hit the subscribe button, ring the bell. You can follow us on Twitter at ICA Gold, Facebook at McIlvaney Financial, or head on over to our website at McIlvaney.com. If you want to speak to one of our advisors here, give us a call at 1-800-525-9556. Thanks for listening.
Have a great week.